Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of the Anup Engineering Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known or unknown risk, uncertainties, and other factors. It must be viewed in conjunction with our business risk that could cause actual results, performance, or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that the company has uploaded the results, press release, investor presentation, and also the outcome of the board meeting on the website of Stock Exchange and website of the company. I now hand the conference over to Mr. Rishi Rup Kapoor. Thank you and over to you, sir.
Thank you. Am I audible?
Yes, sir. Please go ahead.
Thank you and good afternoon to everyone who has joined this call. Before I begin, let me share with you that I have here with me our CFO, Mr. Bhavesh Shah, and Company Secretary, Mr. Chintan Patel. We are officially joining today for our Concall for Q1 FY23. Let me begin by taking you with through our numbers for Q1 FY23. The revenues at the same level at 52 crore. We have a very strong order book and WIP, which provides a good revenue visibility in the coming periods. EBITDA is at 9.4 crore, that is 18.2%. This is primarily because of the impact of high material prices. We have an all-time high opening order book of approximately 537 crore. Also, we have booked orders worth almost 70 crore since 1st of July till date. Current year order booking till date is about 263 crore, including the highest ever order of rupees 103 crore from a public sector refinery. I'm happy to share with you that we are in advanced stages of discussions for a technological tie-up for more complex and advanced designs equipment, and we will be sharing the details with you once the collaboration, the agreement has been inked. On the capex front, we were able to make significant progress by achieving some important milestones, including the new L1 bay with a lifting capacity of 150 metric ton, along with a clean room facility, which will allow us to tap the exotic material segment and upgradation of existing bays. We were also able to speed up the progress of construction in our new facility at Kheda, which will be at the cornerstone for the future growth. Thank you, and I shall be happy to answer any questions that you may have.
Thank you so much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Anyone who wishes to ask a question may press star and 1 at this time. We take the first question from the line of Raj Shah. Please go ahead.
Yeah, hi, afternoon, gentlemen. So I have the question that did we face any execution challenges during Q1? Because from what I understand is that during the Q4 call, we had an order book of, I think, 393 odd crores, and the management had guided a revenue of more than 400 crores for FY23. Now that the Q1 is out of the picture and, we're just at more or less similar levels when compared to last year, did we face any challenges on the execution side? That's question number one. The question two is, does the management retain the guidance for 400 crores of top line for FY23, now that the order book is just increasing? And my third and the last question is that, we've seen an 18% margin for Q1, and, now we have seen the commodity prices softening going forward. So can we expect the margin to go back in the range of 20 to 24% or so? Thanks.
Thank you. Thank you for your question. As far as the low revenue in Q1 is concerned, I think this is mainly a result of the selected revenue mix that we have with most of the deliveries which are slated to happen in the subsequent quarters. That means that, now onwards or quarter 3 onwards, quarter 2 onwards will be the most of the deliveries of our, for our revenue mix that we have selected for the year. Yes, we are trying to pull them forward as much as we can, but this is how it is. So there are no, to answer your question, there are no operational challenges. In fact, on the contrary, if you look at the closing WIP, it's an all-time high of about 85 crore. This is the level of the WIP that we have opening for the quarter 2. As far as the turnover, I think the revenue guidance that we have shared in the previous on call for the year, there is no change in that. Like I said, that in the revenue mix has been selected based on the deliverability and all factors have been considered. So we retain revenue guidance of about 380 to 400 crore for FY23. As far as the margins are concerned, yes, it is an impact of the escalations in the material prices, and that impact will continue to be there with us. However, we are confident that we will be closing the year with about a 4 or 5% hit on the EBITDA margin at about 20%.
Okay, that is from my end, and all the best to the team.
Thank you.
Thank you. We take the next question from the line of Saket Kapoor from Kapoor and Cooperation. Please go ahead.
Yeah, namaskar, sir. And thank you for the clarification, and thank you for hosting the Concall for the benefit of analyst investor community, sir. We hope for the continuity. Sir, as during the yesterday AGM also and earlier also in your quarter 4 Concall, you did guide it for this 380 to 400 band, and now the first quarter being a very soft quarter. So the run rate is definitely going to improve significantly if they're even nearing any way between 380 to 400. Mane easily 100 crore plus run rate is envisaged just to reach this mark, even on the lower side at 380. So that understanding is correct, that this is the bottom in terms of the execution cycle, and now it is only the upward graph that we are expecting from September quarter from this quarter itself.
Yes, that is correct.
Okay, and in terms of margin profile, sir, for the year as a whole, we will be trending at 20% margin. What was our margin for the last year, sir, FY22?
I think for FY22 it was about 24.5%, and we are looking at closing FY23. We are expecting to close it around 20% mark, taking a hit of about 4 to 5% on the EBITDA.
Okay, and Q1 was 19%.
Q1 was like 18%. Yeah.
18%. Correct, sir. And you did mention that this is the deliverable cycles are from the client end are mapped in such a way that the delivery of the scheduled deliveries are post June. So that is the reason there is a built up in inventory and the working capital in progress has gone up to 80 crores.
That is correct.
Okay.
So if you see, just to give everybody a sense of the whole comparison. In the previous year, if you look at the closing WIP for Q1, it was somewhere in the region of about 44 crores, and in the current year, it is about 85 crores. So that gives you an idea.
Correct. Sir, in your presentation, you have mentioned that for better synergy, fungibility, and optimally utilize the capacity at Uddhav and Kheda, you would be operating Kheda as a plant to the existing company rather than the subsidiary. If you could explain, sir, what are we trying to convey from here, sir?
Yeah. So initially we have decided to operate Kheda facility as a 100% subsidiary to take the advantage of Section 115D BAB, which is at subsidized interest taxation of 15%. But since there were certain clauses in that section which restricted the fungibility between both these units. So there were a lot of transfer pricing issue if we had to shift the material from our current premises to Kheda premises. So it was being decided to optimally utilize both the facility. We will be operating Kheda as a plant rather than the subsidiary.
Okay, so the taxation would be at 25%.
Yeah, 22% and plus surcharge 25%. Yes.
Okay.
Overall taxation will remain at 25%.
Correct. And sir, if you could throw some more light, sir, I think our presentation is one of the best, sir, for an engineering organization. I mean, majority of the questions are very well answered in the breakup of the presentation. So I'm very thankful to the team for preparing a very conclusive and exhaustive presentation. Sir, if you could explain to us the benefits that the company would derive in terms of revenue and the profitability when the Kheda site comes on stream. Also, sir, Roop sir, you mentioned in the last Q4 Concall that you would be in a better position to give outline how the business will move ahead of FY23. So now with this order book and the business environment, so could you please give us some more color? How are we looking ahead for FY23 and beyond? If you have some color on the same, these 2 points, sir.
So I think there are the main 3 drivers for our growth that we had decided when we started on this journey, and the first one, of course, was the capex and building of the Kheda plant, which would give us the much needed capacity augmentation along with some capabilities, which could be counted as one of its kind and the most state-of-the-art, highly advanced kind of facilities for these kind of engineered equipment. So Kheda plant, once it comes on stream, it is going to be done in 3 phases. The first phase we are likely to complete in the current financial year. Sometimes beginning of sometimes in the beginning of Q4 is where we are likely to have this plant closer to completion and commissioning. This is going to add about 150 crore to the revenue, and we are talking about going ahead the next 2 phases. Once they are all completed, we will have almost 500 crores coming from Kheda. In terms of the revenue contribution, it would be about 500 crores, and beyond the phase 3, it will definitely, when we look at 500 crore, it is not even full utilization. There is a good 5-year runway beyond that, which will allow us to enter new segments, new industry sectors, and take the growth further beyond 1,000 crores overall. So I think that's where we are talking about the first pillar for this growth. The second is, of course, we are reaching out to our customers. We are building, references, getting the approvals, getting the technological tie-ups to get into more and more advanced designs of equipment, especially heat exchangers and other proprietary items. I would be happy to share with you that from the current order book, almost about 60% would be contributed by these special design heat exchangers, which is in a way also responsible for us to be able to hold on to the margins. Yes, we are seeing a hit, but still, if you were to compare with some of the other businesses which are impacted in this, I think it is a much better.
Look at the breakup of the order book between domestic and export. It is only 10% that we have garnered from the export segment. So any reason, or is it the tough competition or the vulnerabilities that are involved in export, that addressable market in the country and also on a global basis?
I think the more proportion of heat exchangers is simply it's a reflection of the fact that we are currently the entire world. We are going to focus on heat exchangers, shell and tube heat exchangers, and exotic equipment. So that's the product mix. Non-heat exchangers, that is the columns, reactors, and pressure vessels. We have envisaged KEDA to come in and that kind of a bandwidth to deliver the best of equipment and the most critical, most complex of those I have explained. As far as the proportion of export is concerned, see, we generally there is a global competition which is being faced by us here in India for Indian projects. So it's chemicals and chemicals. So it's purely a reflection of that. And whatever work we are doing here in India, it is all with every supply, with every dispatch that is happening. We are taking our credentials a notch higher. This is what has been we have done consistently over the past 4 or 5 years, and we continue to do that. And this will hold us in very good position as far as the global market is concerned, to go out to the customers and present to them and showcase to them our capabilities. And we intend to do it in several forums, including global, multinational exhibitions, as well as, one-on-one meetings with the customers to showcase to them, to present to them our capabilities. Good track record which will help us to bring these customers to.
So, sir, going ahead, how should this mix be looking like? Currently, it is totally domestic only, 10% here or there. Is that there are people who to our product and they, because of some constraint, won't be able to a bigger role here. So, are these sectors are the one that will give us export growth opportunity? And going ahead, how the percentage would like?
I requested to restrict their questions to 2 per participant.
Sir could answer my question.
Please, going forward, action of export is going to normalize, and perhaps it will be evenly. Sometimes we will be taking big strides in the international market. So putting these two together and considering the fact that we will be making more international customers as portfolio is going to grow, it will eventually settle somewhere about 50% exports and 50% domestic.
Will be executed over what period of time, and why still we maintain the margins will be in the range of 20% downward trend? So why still we are in a muted outlook on the margin front?
Chetan, I think this 537 crores plus another 70 crores will be delivered in the next year, so that's 34. Booked post, you can say, in the last 150 crores, or we were operating at about 25% EBITDA. These are those kind of orders. I think maybe about I would think that somewhere in the region of about 350 crores would be, 320 crores is 320 to 330 crores would be at historical margins.
Which is 25%, right?
So 320 out of let's say 600.
Okay. Sir, I was going through the quarterly numbers. The gross margins YOY have declined by close to 180 basis, but there is a dip in the margin by close to 400 basis. And on the QQ level, there is a uptick on the margin front, on the gross margin front, but still we have seen a sharp down on the EBITDA margin front, sir. So could you explain the divergence because of that?
Yeah, Chetan, the other expenses which have gone up is due to our execution much higher than our revenue. So if you see our is up by close to around 20 crores in the current quarter. This has been absorbed at the WAP stage. So our execution was much higher than our sales in Q1. So
as we move along, it will depend on, because several of these orders that we have received recently are which were received maybe about 2 months back. They are still in the initial ordering stages. Maybe the major raw materials would have been ordered, but still there are some of the peripherals that have to be ordered. So where they have been booked at traditional profits. However, there were some orders where the
Okay. And sir, last question, the balance order book out of the 600 crores, of which you said 325.
We take the next question from the line of Kunal from Chameleon Asset Management. Please go ahead.
Hi, thank you for the opportunity. I had 2-3 questions. One was basically we received a very big order of 100 odd crores on count of one refinery. So if you could explain the traction as to how the bid pipeline is going forward, and how should we unit. We have the execution capability of doing about 450-500 odd crores, and then there is additional KEDA. So 2 parts to this question. How is the order pipeline? That's the first part of the question. And second, the execution from the current facility. Hello?
Hello.
Was I audible, sir?
Yes, the order book, I think order flows are continuing, and we are expecting a similar run rate that we have experienced in the past maybe 3 to 4 months. So we have a strong facility as far as the inquiries and the probable orders are there. And the second part of your question, please.
Any sizable order, sir, to the tune of 100 odd crores? Was a quite sizable order considering the size of orders or the size of heat exchangers to the tune of about 3-4 odd crores per unit that we do. So anything specific out in this particular order? Is it a one-off kind of an order, or how should one look at that?
I think it's just it's a milestone of 100 crores. That's in a way a first for us. But apart from this, for us, it's not something very new, because we have been knocking up orders in excess of, let's say, between 50 to 70%. We have had several orders over the past, let's say, 5 years in this category, in this range. So as such, it was just 100 crores plus, kind of number which was there in a single order. So that was the speciality here. And apart from the fact that it was another, category of our advanced heat exchangers. So that's where it was.
And do we see any sizable orders pipeline in the bid pipeline as well, going ahead in the current year, possibility of getting converted into order?
I think this is going to happen, because we are now amongst the leading 4 competitors in India for this work, and we will be encountering more of these large heavy orders.
Okay. And sir, on the execution part from this facility, how should one look at that?
This facility is, I think it is capable of delivering anywhere about 500 to 550 crores going forward, because we have completed the capex here in Odha with the commissioning of the clean room. It is done now. So this is capable of delivering up to 550 crores. And we are, like I said, we are looking to set to grow at a CAGR of 25% here on.
Mm-hmm. Okay. 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 And sir, how much money we have spent in the current year for the Kheda facility so far, and how much we plan to spend for the Kheda facility, considering that it will have a revenue potential of 100 to 150 crore in the first phase?
Yeah, the total CapEx is 115 crores, and 30 odd crores have been spent already in last year, and current year we have spent around 25 odd crores, so 60 more crores to go in next 6 to 9 months.
Okay. And just one question on, sir, correct me if I'm wrong, sir, but right, we see the competitive intensity kind of increasing in this space, right? So does that kind of also putting a pressure on the margins? Because if I could understand correctly, out of 600 crore order book, right, you mentioned that 330 odd crore order book, right, or probably 270 crore order book, which is to be executed in the next year, would have margins of like 25 odd %, right? But still the remaining, if I see the movement of the order book from Jan to March, there's still like a good 150 odd crores, post which the prices have kind of cooled down. So still, we are guiding only for 20% kind of margins, wherein historically we have been at 24-25 odd % kind of margins. So somewhere to read through, is it because of competitive intensity as well?
Not at all. I think it's purely a reflection of the market, the conditions where the prices shot up. And you can't treat the steel that we buy as a commodity. It is not categorized as a commodity steel. It's a specialty steel. There's some very stringent requirements are there, and we have very few suppliers worldwide. So there the impact was even higher. So it's purely a function of price escalation that happened. And a lot of the orders that we got were nickel bearing. And as you know, nickel has been extremely volatile, especially in the phase between February to May. It has been extremely volatile.
Correct, sir. But historically, we have mentioned that as soon as we receive the order, we have got back-to-back arrangements for booking of the raw material as well, right? So in that sense, our gross margin still should be protected in that sense, right?
Not at all. I mean, these were exceptional situations. We had taken the orders, the customers, because the prices are valid, our bids were valid, but our suppliers, they are not according with the similar kind of, you can say, facility or a similar kind of courtesy. If there is an exceptional circumstances like this, they can go back on their prices, on their offers. We also had that choice, but we chose not to do that because we are in this for the long run, and these are our customers, and we didn't want the opportunity for taking the project, participating in the project, or delaying the project in any case. So we went ahead and took the orders.
Correct, fair enough.
Yeah.
Cool. So just one last question from my side, sir. We mentioned that we would get done with the Kheda project by latest early Q4. So, I mean, the order booking for the same would, I believe, start only in FY24. Would that be fair understanding? And execution post that, there will be some lag for audit of those facilities and all of that as well? Or how would be, when should one start order book accretion on account of Kheda facility building in our order book?
There is going to be a set of orders which we can start execution in Kheda once it is commissioned, once it is ready to be taken in for production. However, a lot of our customers, in fact, a majority of our customers would like to visit the sites, would like to audit the facilities, and whether they are at par with the existing facilities or not, or better. So there are formalities that have to be completed. I guess that, according to our estimates, if we commission the Kheda plant by the turn of the financial year, by 31st of March, we should be ready for, taking orders from there in the middle of the next year. Maybe, somewhere in the quarter 2, we will have the orders specifically for Kheda.
Okay. So order book accretion on account of Kheda would only happen from Q2 FY24.
Yes.
Okay. And from the current facility, we have room for another 100 crore kind of execution if we close the year at 380, 400 odd crore execution. Right, sir?
And if you would have listened to what Bhavesh had to say earlier, that we are, now developing this plant. It's like a, it's an extension of our facility. So that allows us to have some kind of a, kind of a complementary existence between these two, cooperation between these two facilities. Even for
okay, so that leaves a little bit more room for execution on the higher side.
Absolutely. It will definitely add to our capacity.
Okay. Thank you, sir. I'll join back in the queue, sir.
Thank you. We take the next question from the line of Raghav Soni, an individual investor. Please go ahead.
Good afternoon, sir. Sir, my question is on EBITDA margins. So going forward, since we have clocked the significant part of our order book at historical level of EBITDA margin, so won't it be higher than 20% what you are guided? So this is my first question, sir.
No, it is not going to be. It is going to be higher than 20% in the next financial year. That is FY24. So most of these orders will flow over to the next year.
Perfect, sir. And sir, secondly, on the run rate from Kheda facility. So going forward, what type of run rate we can expect from Kheda facility? Because you have been mentioning that revenue CAGR would be...
Mr. Soni, I can hear some disturbance from the connection. You may go ahead.
Perfect.
Sorry, could you repeat what
Sure, sir. I'll repeat my question. Sir, my question is regarding the revenue run rate. So you have been guiding that revenue run rate would be close to 25% CAGR. So in the same line, I was just asking about the revenue run rate from Kheda facility, which is supposed to commission from H2 of the current financial year.
Yes, it will commission by the end of the financial year. Yeah. It will also see a similar kind of growth rate. So both put together is what we are looking at a CAGR of 25% from here on. Both facilities put together.
Perfect, sir.
Yes.
Thank you.
Thank you. We take the next question from the line of Ajit from Nizar Securities. Please go ahead.
Hello, sir. Good evening. Am I audible, sir?
Yes, please.
Sir, thanks for the opportunity, and few of my questions have already been answered. So just I wanted two clarifications, sir. Sir, what is our current capacity utilization? And the second one is, sir, you told that we are among the top 4 leading competitors in India. So just wanted to understand who are our competitors in heat exchangers and pressure vessels, which are our major products. Sir. That's it.
Yeah, capacity utilization would be to the tune of about 80%.
Okay.
And our major competitors would be Heavy Engineering Division of Larsen & Toubro and ISJEC.
Okay, understood. And is this capacity utilization similar to the previous year, or is 80% standard or what, sir?
It has been, on the, I think it's similar to last year. Last year we had one, less day because the L1 bay was not commissioned. So this year we also have that day contributing.
Okay, understood, sir. That's it from my side. Thank you so much.
Thank you. We take the next question from the line of Yog Mehta from Scan Capital. Please go ahead.
Good evening, sir. Congratulations on the record order book and the commissioning of the clean room. Sir, I just wanted to understand, given that you said that the export revenues would be contributing half and the revenue potential from the Kheda side, sir. would we be seeing a pull forward of the 1,000 crore guidance for FY27?
Not really. I don't see that we'll be able to pull it forward, but
Okay.
I think we are on track.
All right, sir. And sir, just one more question. Sir, we had said that we were trying to get into fermenters and bioreactors and other capital goods in previous con calls, sir. Any update on that front?
I can only say that the work is in progress, and I mean, that's something which is very high on our agenda, and it's in fact increasing the customer portfolio and also the product portfolio is something which have been designated as key drivers of growth for us. So it's something which is very high on the agenda, and it's a work in progress.
Sir, one more question, sir. Actually, two more questions, sir. Just a little small question, sir. Sir, given that we are manufacturing heat exchangers and columns, reactors, and pressure vessels, sir, we haven't seen Nuclear Power Corporation of India Limited, NPCIL, as one of our clients, sir. We haven't mentioned them, and I think we should be having orders from them, sir, given they require the equipment we produce, sir. Any update, like any comments on that, sir? And sir, one more question, sir. Do we track the turnaround time for any of the orders, sir? Like the execution time for any of our orders for the machinery?
To answer your first question, NPCIL has been one of our clients, and going forward, I think nuclear equipment is going to be one of the business segments that we will have, and KEDA is going to play a key role over there. Okay. So that is one. And the second question, if you could please repeat.
Sir, I was just asking, like the orders we receive from clients, do we track the turnaround time, the execution time to deliver to them? And has there been any progress on that front?
Well, I can only say that we have the best track record when it comes to on-time delivery, and we maintain our leadership position for the last 6 or 7 years consistently, and we retain that position. We are delivering upwards of 90% on time or before time.
Okay, sir. Sir, just one update, sir. If you could add NPCIL in our client list, because it isn't there in presentations or anywhere else, so that was a doubt. And sir, thank you for taking my question, sir. Godspeed. Thank you, sir.
Thank you. Thank you.
Thank you. We take the next question from the line of Ankit from Shubhkam Ventures. Please go ahead.
Yes, sir. Good evening. A couple of questions. So with strong traction in order inflows, I mean, you've already booked some 265 crores till July in 4 months, and you mentioned that this momentum will continue. So is it fair to assume that for the full year, your order inflows will actually cross around 700 crore mark?
I think it's too early to say that. I can just tell you that, we will definitely have something upwards of 500 crores for the next year. Order book, opening order book.
Opening order book of at least 500 crores is what you mentioned. Hello?
Yes, please. Yes.
Okay. And so second is now with KEDA coming, where more complex and high ton range of products would be manufactured, wouldn't it have margins higher than your normal margins of 24-25%? Because the competition level would be less, and those would be more complex products.
I think that is what we are heading towards, and that's the whole idea. As you see, we have made rapid progress in terms of the kind of equipment that we have been delivering, and every year we have seen an improvement there. So of course that is something which doesn't get reflected in the numbers that generally analysts analyze. But it is definitely something which has been very consciously being pursued by us, and we are being largely successful in that. And in the coming years, and once KEDA is on stream, definitely it will be reflected in the bottom line as well.
Okay, and sir, lastly, kindly give some more details on the technology tab which you are seeking. I mean, how is going to upgrade your existing skills? Which area you people are, looking for tie-up, and how can it scale up your addressable opportunity?
I think that is again, we are working on all fronts, on all product categories, whether it is any kind of process equipment, any custom-built equipment or heat exchangers or vessels, pressure vessels, reactors, columns. Everywhere we are looking to scale up the kind of equipment that we are doing, and one way to do it is, of course, engaging with technology providers, something specialized, and we are being quite successful is what I can share with you at this stage. As we move forward, as when we are in a position to share with you more details, we will do that.
Okay, and just one small follow-up in this, the KEDA capex, what kind of asset turnover you are looking at in the phase 1?
The phase 1 would be close to around 1.3 to 1.4, but overall it should be 2. Because in phase 1 there will be a lot of ancillary facilities which has to have that since it's a research check. So initial phase it would be between 1.3 to 1.4, and going forward overall at the end of all the phase of KEDA it should be 2.
Okay, because to the best of what I could gather was that in phase 1 it was 2, and on incremental capex you people had mentioned it would be 3. So has there been any change in that?
No, there has not been any change. I think we continue to have it the similar run rate.
3 times on incremental capex at KEDA asset turnover.
Yeah. Overall, two asset turns.
2 times. Okay, fine. Thank you so much, sir.
Thank you.
Thank you. Due to time constraint, we take this as the last question. I would now like to hand the conference over to Mr. Rishi Roop Kapoor for closing comments.
Well, thank you everyone for participating in the conference call, and I hope we were able to answer most of your questions. Thank you once again.
Thank you. On behalf of the Anup Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.